Today's financial advice is sponsored by Endeavor Private Wealth. Chris McGee, managing partner at Endeavor Private Wealth, is joining us for our weekly segment on investing. Chris, good morning.
Good morning.
All right, Chris, I want to put you on the spot right now. So, okay, tell us, which investment approach do you favor more? Active investment management, such as like investing in mutual funds, or passive investment management, utilizing index funds?
Yes, thanks, Dane. So I'm glad to share with you my perspective on active and passive investment management. But it's not really about which one's better or which one I favor. It's more about the differences between the two.
Okay.
So let's look at some of the major differences between those.
Okay, that sounds good. So let's start with passive investment management, kind of index funds.
Yeah, so passive investing is going to be basically trying to replicate or mimic different composites of the market, both stocks and bonds. And some of the major composites that you might be familiar with would be the Standard & Poor's 500, or better known as the S&P 500, the Dow Jones Industrial Average, which is 30 U.S. large cap companies, and then another one would be the Aggregate U.S. Bond Index, which tries to replicate the bond markets. And there are actually hundreds of indexes that are out there.
Okay, so they're designed to replicate, something essentially. That means they can't really deviate from what they're trying to replicate. Is that accurate?
Yeah, that's correct. So they don't deviate in any way. The Dow Jones, for example, is going to hold those 30 U.S. companies in its fund, and it will not use any discretion and associated with that. And ultimately, it tends to be a lot cheaper and cost-effective because it doesn't have to go out and hire the money managers and the analysts and some of those items that a active managed portfolio does. So indexing tends to be a lot more cost-effective for investors. Okay,
so you touched upon the actively managed funds. Yeah, go more into that.
So you've got on the active side, you've got basically where you have a money manager that's trying to outperform a benchmark in doing so. Now, some of the pluses with that is that you're seeking a money manager that has superior stock selection or bond selection in their choices. They're basically taking on the approach of high conviction on what they own or don't own as an option, and they are looking to pursue opportunities to either add value or maybe a defensive stance in order to protect the portfolio. And ultimately, their goal is to try to outperform the benchmark would be their peer or category that they're in.
Okay. Well, Chris, we're almost out of time, and I sense there's a lot more to consider that we can discuss in future programs. But for now, do you have any final thoughts?
Yeah, so I think we'll sum it up with, when it comes to index or benchmark investing, you're really just trying to align yourself with that benchmark, and whether you're going to perform in line with that, whether that's positive or negative, just depending on what the benchmark does. When it comes to active investing, you're trying to beat the benchmark and outperform that, but that's really going to come down to the individual money manager, and through their judgment and skill and conviction and fees, are they able to provide that extra value for you?
All right. Well, thank you so much, Chris. I always appreciate your time here. And to learn more about Endeavor Private Wealth, visit endeavorpw.com.